Hi, I'm Min, your go-to financial expert who loves sharing insights. Today, we're meeting Jane, who's excited to discuss her new business idea. Later in this video, we'll take a deep dive into IRR. I'll also break down how major companies use IRR, explain the differences between IRR and XIRR, highlight some key limitations of IRR, and show you how MIRR can help overcome those challenges.
Hi there, I'm Jane, the ultimate rich but smart kid with nothing but money and a wild streak for taking risks. I'm always cooking up crazy business ideas and daring investments because when you've got cash to burn, why not have some fun with it?
Jane wants to open a coffee shop and needs to determine if it's a good investment. She meets Min Guru in a cafe.
Min, I have this great idea to open a coffee shop. I think it could be really profitable.
That sounds exciting, Jane, but let's look at the numbers to make sure. We'll use the internal rate of return, or IRR, to see if this investment is worthwhile.
What is internal rate of return? How is it different from rate of return?
Good question. Imagine you invested $100,000 in your coffee shop, and in the first year, you got back $10,000. Your rate of return would be 10%, right? Because $10,000 is 10% of $100,000.
Makes sense.
This 10% tells you how quickly you get back your money in exactly 1 year compared to your original $100,000. But what if the amounts varied each year? Some years you might get $70,000, other years only $40,000. And what if it was for exactly 5 years? Calculating the rate of return becomes more complex. This hidden rate of return is what we call the internal rate of return, or IRR.
Got it. So IRR is like the magic number that balances everything out over time.
Exactly. To find the exact percent, we use the IRR formula. Don't panic. I promise it's much easier than it looks.
Okay, so I plan to invest $100,000 to start the coffee shop. I expect to earn $30,000 in the first year, $60,000 in the second year, $90,000 in the third year, $65,000 the last 2 years.
To calculate the IRR, we need to find the rate that makes the net present value NPV of these cash flows equal to 0. It's like finding the perfect balance. Let me solve for IRR. I'm going to take net present value equals 0, which is calculated as minus 100,000 plus 30,000 divided by 1 plus year, plus 60,000 divided by 1 plus year to the power of 2, plus 65,000 divided by 1 plus year to the power of 5. Okay, the IRR for your coffee shop is approximately 15%. An IRR of 15% makes net present value of all future cash flows equal to your today's investment. If your expected returns hold true, your investment in the coffee shop will generate a return of 15%. But what does this mean for your decision?
So, if my required rate of return, or the minimum return I need from an investment, is less than 15%, then this coffee shop is a good investment. If it's higher, I should look at other options.
Exactly. And if your business borrows money from the bank at a 4% interest rate and your IRR is 15%, then you win 11%, 15% minus 4%. On the other hand, if your borrowing cost is 4% but your coffee shop's IRR is only 3%, then you lose.
Got it, Min. My required rate of return is 10%, so 15% sounds great. Let's go for it.
And just like that, Jane was ready to take the plunge into the coffee business, armed with the wisdom of her financial superhero, Min Guru. She gradually vanished into her business fog, leaving behind only the aroma of potential. Whether her coffee shop would succeed or not remained a mystery. One thing's for sure, I never got a thank you latte. And there you have it. Through Jane's story and our simplified example, we've seen how IRR helps evaluate the profitability of an investment by comparing the project's return to the investor's required rate of return. A higher IRR means a more attractive investment. Stay tuned for a deeper dive into IRR. Next up, I'll explore how big companies apply IRR the differences between IRR and XIRR calculations, key limitations of IRR, and how MIRR can overcome these challenges. In large firms, IRR is used in conjunction with other metrics like NPV, payback period, and profitability index to make comprehensive capital budgeting decisions. When the choice is between two mutually exclusive projects and the NPV and IRR rank the two projects differently, the NPV criterion is strongly preferred because, first, the NPV shows the amount of gain or wealth increase in company value as a currency amount while IRR shows a percentage. Secondly, the NPV assumes reinvestment of cash flows at the required rate of return, which is more realistic than the IRR assuming reinvestment at the IRR. If NPV is always preferred over IRR for selecting projects, why do companies even bother with IRR? The answer is that many people find a rate of return easy to understand. If they know that the required return is 10%, they can easily understand that a project returning more than 10% is desirable. Microsoft Excel and Pocket Calculator can help solve IRR in most cases. Microsoft Excel uses the IRR function for a quick calculation. Just plug in your cash flow values with the formula for IRR. This method assumes cash flows are evenly spaced and occur at the end of each period. When cash flows are irregular, Excel's XIRR function comes in handy. It accounts for the exact dates of each cash flow, offering a more precise calculation. Conveniently, most financial calculators come equipped with a convenient IRR function, enabling quick and efficient calculations on the go. To compute IRR, simply input the cash flows and time periods, then press the Y button followed by CPT. The calculator will instantly display the IRR as a percentage. Besides its advantages, IRR does have big limitations: scale insensitivity and undesired multiple IRRs. IRR doesn't account for the scale of the investment, which might lead to misleading conclusions when comparing projects of different sizes. When comparing multiple projects, relying only on IRR can lead to choosing a smaller project with a higher IRR over a larger one with a lower IRR, even if the larger project generates more total profit. For instance, a project with an IRR of 20% on a $10,000 investment might produce only $2,000 in profit, whereas a project with an IRR of 12% on a $1 million investment would generate $120,000 in profit. The lower IRR project is clearly more beneficial in terms of total profit, but IRR alone wouldn't highlight this. Another issue is that when the cash flows are non-conventional, such that they change sign more than once, there are multiple IRR. Non-conventional cash flows that change signs multiple times can result in multiple IRR, causing ambiguity. The Modified Internal Rate of Return, MIRR, is an enhancement of the traditional IRR that addresses some of its key limitations. The assumption about the reinvestment of cash flows and financing cost in multiple IRR. How can MIRR solve these limitations? Imagine a company is considering a project with an initial investment of $500,000. The project is expected to generate cash flows of $300,000, $200,000, and $500,000 over the next 3 years. The cost of capital and the financing cost are 10%. Using the MIRR approach, the company would compute as follows. First step is to calculate the future value of the cash flows $300,000, $500,000 assuming they are reinvested at 10%. Next step is to calculate the present value of the initial $500,000 and $200,000 assuming it is financed at 10%. Finally, use the MIRR formula to find the modified rate of return. I hope you found this explanation helpful and easy to follow. Comment below if you want more video like this or advanced knowledge on IRR. Thanks for watching, and remember, understanding finance is the first step to making informed decisions. Subscribe to watch the next video.